In this video, I will introduce you to the concept of working capital management and explain why is it so important for businesses to manage their working capital. There are two types of capitals which are invested in a business. One is the long-term capital and the other one is working capital. The long-term capital is the capital which you would invest in the non-current assets of the business and keep using them over a long period of time. So let's say you start a shop or a cafe or a small factory, and for that you need to have a land, building, you need to have plant and machinery, other furniture and fixture. All of the monies invested there are non-current capital. Now, after you have set up everything, then you need to start producing or providing service or whatever you do. You need to start your operations. You will need money for operations, and that money is called working capital. You will need that, for example, to buy inventories if you sell something, or to hire staff if you provide service, and then pay their wages, pay electricity bills, pay all bills, and so on. So this is the working capital. If you run out of this, then you either have to invest more money into it by taking a loan or investing your own money. You cannot afford to run out of working capital. Good businesses are those businesses who run their business on the minimal amount of working capital needed. The reason is that the working capital is the capital which is not actually making money for you. When you invest in an asset, that makes money for you. There are so many businesses, for example supermarkets, who don't invest any money in the working capital and keep running those businesses. So those businesses are more efficient businesses. So ultimate aim of working capital management is that we do not have to invest money in the working capital, or if we do, then it is stable. It doesn't demand more money. A business which keep requiring more money to be invested in working capital eventually runs out of the money and then goes bankrupt despite having a profitable business. The definition of working capital could be the amount of money which is invested to run the business on a daily basis. For example, paying wages, buying inventories, paying suppliers, etc. If you look at working capital, can also be defined as the difference between current assets and current liabilities. Hence, the equation for working capital is working capital equals to current assets minus current liabilities. What is part of current assets and current liabilities? That makes elements of working capital. And there are four major elements of working capital which you would see in current assets and current liabilities of the company. In current assets, you would normally see three figures. For the first one is cash, that's what you need all the time. The second one is your inventories, and the third one is your account receivables, which are your credit customers. In your current liabilities, there mainly one figure you would see, which is accounts payable. These are your suppliers to whom you owe money and you need to pay them when they ask for it. However, sometimes you will see bank overdraft figure as well, because if the business is running on overdrafts, which is the case actually a lot of time, and overdrafts are a very common feature of many businesses' working capital. So you might see overdraft as well. However, the management of cash and overdraft has similar issues, so those normally are discussed together. In the videos coming next to this video, I will discuss one by one all these four elements of working capital, and then we will discuss how we can best manage those. And the last thing is working capital cycle. The cycle is the whole process on how money leaves the business and then comes back. So once you have set up, you start a business, once you have set up your business, now you need to spend money on inventories, for example. So you pay money to inventories. Maybe some of it are for cash and some of those are on credit. So you get the inventory. then you need to pay your suppliers. Effective working capital management is that you buy those inventories on credit rather than on cash. However, if you're new to business, you may find this difficult. Once you have the inventories, then you will try to sell them as soon as possible and receive money from your customer. Now, then you can sell those on credit or cash. Again, it depends on your type of businesses. If you're selling to businesses, the chances are you will be selling on credit. But if you're selling to end consumer, the most of your sales would be on cash, which is a good thing for business. And then the money comes back to your pocket, basically, or your bank account, business bank account. The effective management is that when you buy inventories, you do not pay your suppliers until your customer has paid you. And if this is the case, your working capital management is efficient. You would like to keep it that way. But for many businesses, this is not the case, especially manufacturing businesses who requires a lot of money invested in the working capital management.